Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and this edition of Street Talk is another episode of the recently launched Tales from Top Performers series, where we're highlighting conversations with executives at high-performing banks and sharing their views on current issues and the greatest challenges and opportunities they see ahead. My colleague Jimmy Pittenger, who leads our U.S. Financial Institutions Commercial team, is here again with me, and we both attended our annual Community Bankers Conference in Dallas last month, which features some of the best advisors and operators in the banking business. No doubt we covered challenges facing the industry, but we wanted to focus on solutions and hear from some of the smartest bankers in the business on how to excel in the current environment. Jimmy, the theme of the event was banking on the possible, and that was your idea. Why did you think that was important, and why did we want to put forth that message to the audience?
Well, thanks, Nathan. I think one of the biggest things, there's a lot of challenges facing banks in today's environment. Net interest margin compression, the competition for stable deposits remains very intense. Efficiency ratios are suffering, and now net charge-offs are starting to kind of creep in, and there's a big story around commercial real estate and some of the stress in that area. So what we wanted to do is really focus on what are banks doing to kind of punch above their weight against those factors from a performance perspective, and what are the unique things that they may be doing. Maybe it could be just a geographic advantage that they're executing on, but I think you'll hear in today's conversation that some of them are doing some unique things from a lending perspective, from a deposit gathering perspective, and try to bring those to the surface to really better understand what these banks are doing to execute.
Absolutely. Well said, Jimmy. And in fact, we are going to share some of the views from three executives who were presenting at our event on our high-performing bank panel. They shared really how they've outperformed in the current environment, and of course, touched on the greatest challenges and opportunities that they see over the next 12 months. The three bankers, South Plains Financial CEO Curtis Griffith, Stellar Bancorp CFO Paul Egge, and City Holdings CEO Skip Hageboeck, outlined how they've been able to maintain strong deposit franchises. That was something we spent a lot of time talking about at the event, and it was something that took up a good bit of that panel, particularly as we continue to see fierce competition for deposits. And we're first going to hear from Curtis Griffith at South Plains, who talked about how that they've really benefited from having a significant portion of their deposits in more rural markets where they face less competition compared to metro areas where the big banks are really dominant. He also talked about how they tend to avoid CD specials. That was something that we heard from a number of presenters at the event who said that CDs are guilty until proven innocent, and how on the commercial side, they've been able to hire expertise and add it to their treasury management functions. Here's Curtis.
We are fortunate that about 81% of our deposits are in what are classified as rural markets, including our headquarters town of Lubbock, is considered rural. Doesn't mean you don't have deposit pressure there, but it's not as intense as it is in the metro areas. We have lending activities, very much so, in Metroplex, Houston, El Paso, but our core deposit base tends to be more rural. And being that, we have a lot of long-term relationships, and it's easy to work with those customers that have been with us many, many years, that we use some brokered funds when we needed to. The reason I'm saying it's kind of a composite of several things that seem to work for us. You got to use them wisely. Don't push the number up very much, but it does help back off some of the rate pressure. I was intrigued, Nathan's slide showing the banks still offering CDs over 4%. Folks in Lubbock, Texas, it would have been more interesting to see the ones offering over 5%, and occasionally some at 6%, at least a credit union was. Wow. So even in those markets, we do have some funding pressure. We are fortunate that we do not have a huge amount of deposits. We're well below peer in CDs. So we try to avoid that. We don't run CD specials. We have not during all of this because, as you all know, when you put a CD on, you can look at when you're going to get to negotiate for it again. and you will on those maturity dates. So we push harder into having them in transaction accounts, money market accounts, high interest checking, other things that we can control those rates. And as long as we can keep our customers happy, we can even do some one-offs on money markets when we have to. And ultimately, if we have to, we also have a very active brokerage operation there in our main headquarters building, and that we can work other branches with as well. I'll maybe a plug, but put it in for Raymond James. They've been good to work with us. And if we have a customer who is just determined they want to buy a CD and they want to get one at a rate that is substantially above what we're willing to pay, and we don't find a way to do something in reciprocals that makes any sense, that's sort of the first approach. We take them across the hall, and the brokers can put them in the highest rate CDs anywhere in the country if they're comfortable doing that. So you can utilize that, because what I preach to our people is don't lose the checking account. Don't let that other bank get in there and start taking that relationship away from us, because that's key.
Then we heard from Paul Egge at Stellar Bancorp, who really talked about the importance of focusing on the core business and maintaining capital and liquidity. Stellar really has an envious non-interest-bearing deposit base and has focused on really servicing their customers, but they also have the unique benefit of having completed a merger of equals just before the liquidity crunch erupted. Paul talked about how in some cases they've split the difference on rates and managed exception pools for their best customers where they really value the relationship. He also talked about how they've optimized their funding base and focused on their value proposition to their customers as they went through the MOE. Here's what Paul had to say.
Unfortunately, what went down with SVB happened, but all the while we, by virtue of being focused on optimization, we were not chasing the hot money. Effectively, as rates were going up, we had an exception program where if our customers valued the relationships and were willing to kind of split the baby on rate, we'd manage an exception pool, and then more broadly, if people were going to top tick for rate, they could sweep those balances somewhere else. And that was largely a function of having a higher level of scale through the merger. We were not scared to kind of shrink in the spirit and thought process of staying core. So pre-SVB, we were at mid 40%, 45-ish% non-interest bearing ratio. But clearly, the client base has behaved in a way so as to optimize their excess balances. We're now at a point where it's about 38%. But I think a lot of what we've done around the merger, rebranding and things along those lines, have kind of kept for a fresh face. And really, we had our conversion the week before SVB, or maybe it was just a couple weeks before SVB. And you get so close to your customer when you're trying to manage through a system-wide conversion, plus let them know who you are, who we were, Stellar Bank, because ultimately the brand was born right then and there a couple weeks before SVB. So the guiding principle has been on this concept of staying core, even if it meant shrinking. So when we closed the merger, we were well over $11 billion in assets. We sit more now at around 10.6 billion in assets, and it is more core. That same kind of mentality when we closed the merger, we sold a lot of securities so as to bulk up our securities portfolio. And the whole key was to put us as a management team in a position where we didn't feel under the gun or desperate, because if you put yourself in that type of corner from a liquidity or funding perspective, you'll throw discipline out the window. So we've been successful up to this point managing and being more disciplined, backfilling with wholesale as opposed to turning our core customer base into effectively wholesale behaving deposits. So there's a lot to kind of work through there. I feel like we are in one of the best markets in the U.S., but on the flip side, it is a big major metro market where there is a lot of competition, and that's probably been the biggest curveball, but a lot of our success is a byproduct of strategy going to and through the merger.
And lastly, we heard from Skip Hageboeck at City Holding, who has one of the best deposit franchises in the country. They boast an envious low cost of funds and low deposit betas. And similar to Curtis, Skip talked about how they benefit from not having to compete with the big banks in large metro markets, but he also really emphasized how they have a very, very granular customer base when compared to other community banks.
Well, I think the first thing I'd say is we're lucky. The city has been a very high profit bank for over 20 years. That profitability is coming from the deposit side of the franchise. As you said, the cost of funds is lower than most banks, and the deposit betas were among the lowest in the industry. And that's because the franchise is 160 years old. We operate 97 branches for a $6 billion bank. And each branch has about $40 million in deposits. So they're small branches in predominantly small communities, not urban communities. We have an average of 2,100 families, households, that bank at each one of those branches. That's close to a 50% over the traditional community bank model today. So we have a lot of customers. As a point to support that, debit card revenues for our $6 billion bank were $28 million. I know lots of $6 billion banks that don't have a third of that. That's because there's a lot of customers. And there's a lot of small customers. If I divide my checking accounts into the biggest 50% of the customers and 50% of the smallest customers, the 50% of the smallest customers are all those customers with a DDA balance under $1,000. So half of my customers have under $1,000. The average for that group is $300. So we have lots of customers. We have lots of small customers. Those customers contribute debit card revenue. They're certainly not contributing a lot of net interest income, but they're contributing a lot of other branch-related fees as well. The markets in which we operate, our competitors are helpful. In most of those markets, we're the only large community bank. We compete against big banks, like Chase, particularly, and Truist in our markets. And I wouldn't want to compete with Chase in New York or Washington, D.C., or Chicago or Indianapolis. But I don't mind competing with them in West Virginia, Eastern Kentucky, and Western Virginia, because they really don't want to be in those markets. And you can see it by the things that they do. They never replace anybody. They just let the company atrophy, and I'm sure they're making tons of money. But that's not their focus, and so we take customers from them. The small community banks we compete against know their customers well, they care about their customers, they treat them well, but they don't have the money to provide the technology and the product that we do. And so even though we have, in our 4 lead markets, 40% of the households bank with us, 40, 50, and 70% of the households bank with us. And none of those markets are growing in population. We're growing our franchise. We're growing households. And that means we're taking the customers from the big banks and the small banks.
So, Jimmy, while a lot of the focus was on deposits, we certainly heard from these bankers what they're seeing in terms of loan competition and evaluating credit risk. Not really a surprise to me that we spent some time there. You know, what was your view of what we heard about credit broadly and what we're seeing broadly from all the banks we're talking with?
Well, I think one of the things that came out of the conference and that we heard from a lot of bankers is anywhere you turn these days, the whispers of strain throughout the CRE spectrum is really starting to kind of come to the forefront. And that certainly was the case at the Community Bankers Conference. We've seen a lot of banks with better disclosures around that, increased reserves, and delinquencies are definitely off of historically low bases. But it really came out that loss content is going to be location specific and differ across subcategories. I think what we heard from Curtis, Skip, and Paul is that it will be unique to the markets that they're serving, and that they can be specific in the way that they're structuring deals in some of those markets, and in a little less competitive markets they can be a little bit more picky. But I think the test for some of the strain in the credit space, specifically tied to CRE, is going to be in the quarters to come as refinancings come at significantly higher rates. We're going to see that play out over the next year. So I think all 3 of them mentioned that they're really focusing on keeping an eye towards that and getting ahead of that, because once it starts going south, you can't, work with, it's harder to work with clients to work out of those situations. I think Curtis said it best, and we'll probably hear this about working with clients, but getting ahead of it.
Absolutely. And here's Curtis talking about how they wanted to get ahead of the issue, as you talked about, and how they're actually incentivizing their lenders to make sure that they're getting paid back, not only just bringing in the loan today.
We will be competitive on rates if we get the deal structured the way we want to with the covenants that we want in the deal. So by doing that and really monitoring loans as we go forward, look at that customer on a regular basis, be sure they're still as strong as we thought they were. And if we begin to see slippage, something that we have gotten better at, there's no perfect solution, but we will stay in there and come back to them and say, this may be a problem and this is a trend that we really don't like. So start early and see if they can resolve the issue, find solutions for them, and if they can't get a solution that works for us, don't be bashful about trying to help them find somewhere else to take that loan. You can't do it after they've defaulted, but you can do it ahead of time. And frankly, that's one reason we were kind of flat in Q1. We actually had some good new business that we brought in Q1. We are still doing a certain amount of ag lending, and so we had some seasonal pay downs in that. And we had a couple of pretty large relationships that we helped exit the bank. And we wish them all the best, and I hope they do really well where they are now. But we didn't want to deal with that when, if, and I personally am still kind of in the when category. It may not be I don't think it'll be a big recession, but I think we've still got some downturns ahead of us. I don't think we've worked all this through the economy. As Nathan was saying, having all that extra cash out there has softened this to this point, but it's beginning to run out. And as we see, particularly commercial real estate deals get repriced, and some later this year, some in 25, and for a lot of folks, quite a lot in 26. So, good Lord willing, maybe rates will be back down a bit by then and the economics work better. But there's going to be some tight situations, and we just want to be ahead of the game in doing that. And that's really what we've done. And again, back on lender incentives, we really not just push them to achieve great growth, but it has to be meeting our standards. And I'm just to share this one. The biggest single haircut on an incentive comp plan that a lender can get with us is if somebody outside the bank, that could be a regulator, it could be an outside loan review, downgrades a loan in their portfolio that we didn't catch. So that catches the credit analyst to be on top of it too, and it definitely incentivizes that lender. Stay in touch with the customer. Know what's going on.
We also heard from Skip talking about them approaching new business with greater caution. But as Skip said, that they benefit from the fact that they don't live and die by lending. They live and die by deposit taking. So they are more cautious than you see some other bankers because they can benefit by having such a attractive low-cost funding base.
So on the loan side, if deposits are the golden goose for Citi, loans are probably the Achilles heel. I'm told by our lenders that it's tough to make loans in our markets. There aren't as many loans as there are other places, whatever that means. It might be true. It might also be true that because the deposit franchise is very profitable, we've always been able to be very tight with commercial credit. So it may be that there are just fewer loans that can meet our standards. We were one of the few banks in 2007 that didn't struggle. And we didn't struggle in part because we were in the right geography and in part because we had pretty tight asset quality. The loan originations, you're specifically asking about mortgage lending. About half of our loans are mortgage lending because the commercial loans we can find that meet our standards are about $2 billion. That on a $6 billion balance sheet, we put $2 billion into mortgages. It's a proprietary product. Works really well, and it's as profitable as a commercial loan, so that's just fine. We don't live and die by lending anyway. We live and die by deposit taking. The residential mortgage business is slow. Originations historically for us are about $250 million a year. Most of that turns into on-balance sheet portfolio. Today it's running about $200 million, but loans are growing because nobody's paying down or off loans. As they ordinarily would. Their mortgages are at 3% and 4%. They'd rather hire a marriage counselor than get a divorce and divide up the house. So the originations are low, but prepayments are low, and the balances actually are growing. I thought one thing I would mention about lending, one of the reasons that we're number 2 on your survey for 2023 was because during the COVID crisis, as customers were coming in wanting commercial loans at 3-4%, we accommodated our customers. We gave them long-term 5, 10, 15-year fixed-rate loans at market rates. But when we thought about where interest rates were going to be in the future, The Fed was telling us that rates were going to be low for 5 years. Never trust the Fed. We didn't know whether that was true. We assumed rates would eventually go up. We just didn't know when. So because deposits were very profitable, we were able to take almost every commercial loan that came in during that period of time. And we do this for most loans anyway. But we were able to enter into a tri-party agreement with PNC, who swapped those into variable for us. And because we can afford it, it meant that we earned less on that commercial relationship than had we kept the fixed rate loan. But when rates went from 25 basis points to 5.5, all of those loans came up and came up quickly. And that was over $1 billion in loans that repriced along with Fed funds.
And then lastly, as you alluded to, Jimmy, Paul Egge was saying that they don't want to run too hot in the current environment.
Keeping with the theme of trying to be better, not bigger, we're really respectful of the constraints of the current environment, and that really speaks when it comes to the loan business to capital and liquidity. We don't want to run too hot from a loan-to-deposit ratio, and deposits are a little more scarce nowadays than they were prior, and we really value the high-quality composition of our funding base. So we're respectful of that constraint, but pivoting back over to capital, we feel that there is very little upside to being an outlier to that 300 and 100, thanks to a lot of the regulatory guidance, I should say, and thanks to a lot of the purchase accounting marks from our merger. We found ourselves a little higher than where we wanted to be there. Fortunately, we've grown our capital base kind of faster than most banks out there due to strong earnings and strong amortization of a CDI asset, but we've put a little restrictor plate, so to speak, on our CRE growth by just really moving up the underwriting standards. And we started this really about a month before the merger, just because, back to that focus I spoke to earlier, trying to ensure that from a liquidity and capital standpoint, we were haves as opposed to have-nots. But a big piece of it was to try and increase that pathway to getting under 300 and 100. We are now under 300. We are a little over 100 on the C&D ratio. But we like to think, getting back to the first part of your question, that our CRE and C&D is is distinct from a lot of the headline risks. First and foremost, not a lot of office. And it really, even if you were to look at what we called office, the average check size is more like $1 million, which is not going to get you central business district office, Class A office exposure. It's just a different variety, and what one of the big risk mitigants in our CRE book is the overall diffusion of risk into loans that are really a meaningfully lower check size. So just under $1 million average CRE loan funded balance. So that is something that we think is a meaningful diffuser of risk. And what we did do is really focus on loans coming due who had solid compensating balances, how can we optimize relationships and effectively not continue to work with folks who are just looking at us from a loan relationship.
And Jimmy, we heard from all three bankers your favorite question that we're asking in this series. What are their greatest challenge and opportunities, with Curtis, Paul, and Skip all opining on those two questions? What do we hear from them? And were there any surprises from you?
I think, one of the things Curtis mentioned is maintaining credit quality as the biggest challenge with potential downturns coming into the economy. And then from an opportunity perspective is the ability to grow, offering good terms and reasonable pricing against banks that may be constrained. So they're looking to go take market share from banks that may be constrained in the marketplace.
Maintaining your human capital, and I know I'm preaching to the choir out here that every community banker in this room knows that you've got to have the best people. And everybody's got great people. We all do it. We all say it, but you got to hang on to them. And it's a little challenging in this environment. It's the hardest I've ever seen. We recruit. We try to bring some in. And we've been generally successful for getting the ones we want, but it is a challenge. The other part of this, I think it is maintaining your credit quality. That's what we're really focused on. Not that it's going to get all that bad. And no, I do not believe we're headed into another, what we went through in the great financial crisis. But if you have much slippage at all, you're going to find regulatory pressure that's going to hold you back, particularly if your core thing is CRE. So you've got to keep that credit really pristine so that you can grow it. You can grow that loan portfolio, and that's the greatest opportunity I see out there right now, at least in the markets we're in, that you can get some good growth because a lot of banks are going to be constrained. If you can be one of those outliers that can go in and give them good terms and reasonable pricing, you can pick up some great business out there right now. And until we see some softening in rates, I think it's going to stay that way.
Paul mentioned that managing constraints in terms of capital and liquidity and not running hot, not chasing deals. And then the biggest opportunity is leveraging their localness and focusing on the Houston market, which is their primary market, and trying to take share from out-of-market competitors.
This is idiosyncratic to Stellar, but Houston is a market that, as I mentioned before, is incredibly overbanked by out-of-towners, and there just aren't enough meaningful banks to scale. And for us, leveraging the localness and really that differentiator to pick up great human capital who care about living and being kind of an elevator bank away from the C-suite, or alternatively, that decisions are being made in town. We think that's kind of a powerful key differentiator to us and one of the best markets in the U.S. So that's the largest opportunity. The biggest challenge, the one thing I didn't mention about our merger, is we are sitting uncomfortably above the $10 billion threshold, and we are managing through a lot of forced maturity as it relates to a lot of our risk management, and a lot of that, shocker, does not bring in revenue. So we kind of feel like from the standpoint of the merger, you go 2 steps forward, but being uncomfortably close to $10 billion in assets, you take 1 step back. How we manage really the imperatives that are very real as it relates to beefing up a lot of our internal risk management programs and things along those lines against really the goals of growing in, unfortunately, a constrained economic backdrop is just, it's a taffy pull that we need to manage.
And then Skip's is the biggest challenge is being loan growth, particularly in the commercial loan space. And from an opportunity perspective, leveraging technology to optimize branch staffing and trying to address fraud more effectively.
With an ROA in the first quarter that was almost 2%, I'm going to worry about challenges first. Loans are always the biggest challenge for Citi, right. Always, commercial loan growth. But I'd add to that, it's not a challenge yet, but I'm really worried about fraud, particularly check fraud, which seems to be growing at a shockingly fast rate. And I'm afraid it could become a real challenge. On the opportunity side, for the last couple years, and I think as well for 2024 branch staffing costs have been an opportunity to lower expense, using cash recyclers, reducing branch staff because customers come in less, using managers to manage 2 small branches instead of just 1. Going forward, we're getting rid of all of our ATMs and replacing them with leased ITMs so that we have the ability to perhaps stick some ITMs in adjacent markets where we may be able to grow customers. Technology is allowing us to hire more smart but fewer workers. Costs the same, but we're getting more output as a result of that. And the other opportunity, I think, is we've got a fraud piece of software coming in that should allow us to address fraud more real time, that I can't wait for.
Well, great advice from some of the best in the business. Thanks to Curtis, Paul, and Skip for participating in the event. And Jimmy, thanks again for coming on the show.
Thanks again, Nathan.